Another interesting organism in the sea, shall we say, is the venture debt or venture leasing. For a lot of particularly innovation startups, they don't qualify for traditional commercial banking, commercial debt. But there are other people that are willing to ride along. Typically, if a company has respected even micro VCs or even super angels involved, then they may be willing to extend the runway, so you get more runway from your equity by financing things that they can file a security interest in. So purchasing equipment, maybe even some working capital. And what they get in addition to just getting repaid the money plus interest, usually at slightly higher terms than commercial debt, they would typically get warrants. And so if there is a winner from that, then they get to participate in the upside for the additional risk. And that's called venture debt and venture leasing. There's a number of different players in the market that provide that. The process of getting approval for a non-bank venture debt or venture leasing company is that you need to convince their chief investment officer that you're a worthy credit risk. What they're looking for, interestingly, in my experience, done a fair amount of these deals, is the credibility of your investors. I know that sounds kind of weird. The thinking is, look, if these people who are providing true risk capital, equity, are in the deal, and we trust their business judgment, we're going to bet that we'll get paid back our money before the ship sinks, okay? Because they're further up and in most cases they do, right? So when things start to go sideways, they hope that the VC firms will take appropriate action to right the ship. But in any case, they're betting that they'll be able to get their money out and get repaid before something bad happens.